That's a real problem for beginners. Even if a beginner recognizes that he's wrong, most beginners don't give up. They say, oh my gosh, I'm down $1,500 on the day. If I exit, I'll have lost $1,500. I'd rather hope that the market turns around and maybe I can get out with an $800 loss or $300 loss. And that's hope. And hope is not a trading strategy. That's one of those trades that come every few weeks.
Sitting down today with Al Brooks. Al, I believe you've been on the podcast here for 5 times in the past, or this is your 5th time. I'm not exactly sure, but it's good to have you back. Good to chat trading once again, and welcome back on the podcast.
Thank you very much, Etienne. I always enjoy speaking with you.
Awesome. I kind of want to go that path and ask you first about price action, and I'm really curious to hear where you learned price action from. Was it a mentor you had in the past, or kind of what got you started in that price action kind of journey?
I think most traders who start trading, or actively trading, they look at charts, and it looks pretty simple. If you're looking at NVIDIA, for example, the chart begins in the lower left and it goes to the upper right, and it looks like it's very easy to make money. I've always been intrigued by pattern recognition. So it was a game. Can I see patterns that are likely to lead to a continuation of what has been happening? Or what are the patterns that are likely to lead to a reversal? And even now, 40 years later, it's still a lot of fun, looking for patterns and trying to assess probabilities and then try to structure trades. It's fun.
Were you doing this alone, or had you had mentors or books to help you along the way?
When I started back in the 1980s, I'm a physician. I went to medical school. And when you're training, you hang around with experienced doctors and you copy what they do. And I applied that logic to trading. And I bought a bunch of they didn't have videos back then, but I bought a bunch of books. I had tutors. I went to work with people, watched them trade for a week. And what I realized was none of it, I couldn't make any of it work. And back in the 80s, it was perfectly legal to be dishonest in promoting things. So there were a lot of, I remember I bought a course on automated trading for $3,000. And the returns were incredible, like 1,000% a year. And every day they send you updates to the parameters. And I soon realized that it was just all nonsense. I believe that the government forced them out of business because of false promises. But anyway, today, there's very little of that. Most of the people now are professional in what they say, and they're worried about the government agencies giving them a lot of trouble if they go across certain red lines. So now it's easier, I think, for someone starting out to find reputable people, because most of the people, try to be reputable. But back then, it was just so dishonest. It was just so dishonest. And I spent all that money and all that time hoping that there would be a savior, someone who would, take me to the promised land, and, help me get rich. I knew I was willing to work hard, and I thought I was smart enough that, if they can do it, I can do it. But it just didn't work, And what I ultimately decided was, if I'm going to succeed, I really have to just start from the beginning. Just look at a chart and try to figure out on my own what the patterns were and what they mean. And over the course of many, many decades, I'm very comfortable in my ability to assess what the market is doing and what it's likely to do next. It's really interesting. I'm so at peace during the day. No matter what happens, I'm at peace and I understand what's going on. There's never anything that happens where I say, oh my gosh, how could that possibly be happening? But back in the 80s, I regularly felt horribly stressed out that, why is the market doing this? 1987, why is it doing that? and a flash crash. Not, I just look back at those things now, and I understand. I understand what's going on, and I'm never on the wrong side. Back when I started out, I think I had a common problem. For example, I could trade well for a week or two or three, and I'd feel like, wow, I finally have it figured out. And then I would place a trade, and it would go badly against me, and I would erase more than everything I made over the past 3 weeks. And I think that's a common problem with beginners. What happens is when they kind of intuitively figure out that, hey, if I use wide stops and if I scale in, I can win a high percentage of my trades. So what they do is just that. They take a position, the market goes against them, they add to their position, it goes against them some more, they add to their position again, betting that the market eventually will go in their direction. And most of the time it will, and they'll either be able to get out without a loss or they'll get out with a profit. But rarely the market will go against them and keep going against them, and it'll go so far against them that they'll wipe out everything good that they did over the course of the past several weeks. And so it's a rare thing, but one rare thing can wipe out 10 or 20 really, really good things. So I think what I came to realize was that it's okay to scale into a losing trade. I do that regularly now. A lot of scalpers do that, and that's how they can win a very high percentage of the time. A really good scalper, if he's using wide stops and scaling in, he can win 80 or 90% of his trades, right? So, that's definitely a good way to make money. But it only works if you have ways to protect yourself. For example, you only hold on to your position as long as you believe your premise for taking the position is valid. So if the market is selling off and you think it's a pullback in a bull trend and it just keeps going down and down and down, you need some method that lets you decide that the pullback is not a pullback in a bull trend, it's now a bear trend. And simply hoping that the market will do what it usually does and eventually turn and go your way, that's not a profitable strategy. So you need to be able to do things that make sense. You need to exit when your premise is no longer valid. So, for example, if you're buying and the market is having a series of higher highs and higher lows, and it has a wedge shape, and then there's a very big sell signal bar closing on its low, bear bar closing on its low, and it's at some major resistance. If you're long, you get out. You don't hold on and then add to the position as it goes down, because there's a 30 or 40% risk that the market could reverse into a bear trend. So if there's a clear sell signal, you get out. And what about the times when the market is going up and you're long, and then the market pulls back and it looks like all the other pullbacks, but it just keeps pulling back. So it keeps drifting down with little bounces along the way. It's not going down very fast, but at some point you have to decide that your premise of a bull trend is wrong. This is no longer a pullback in a bull trend. It's a bear trend. And you have to have tools to be able to make that decision. One obvious one is when that happens, I would say 90% of the time, after about 20 bars, you'll see a pair of very big bear bars closing near their lows and below the most recent low. In other words, you'll see a bear breakout. So what you thought was a bull flag is now breaking out to the downside. And so if you see a pair of big bear bars closing near their lows and both close below a prior low, for example, you think the pullback is forming a bull flag and it's starting to turn up, and then there suddenly are these two big bear bars, both closing near their lows, both closing below the bottom of what you thought was a bull flag. and the body of that second bear bar is completely below the bull flag, you have to know that the market is now in a bear trend. And those two bear bars were formed by the final bulls giving up, the institutional bulls giving up, and by institutional bears deciding, yeah, this is a bear trend. It's no longer a pullback and a bull trend. So if you see that, you have to get out. But I think a lot of beginners will say, nah, you know, you know, there's this big bull trend. This can't be a bear trend. There wasn't a clear top. The sell-off didn't begin all that strongly. This is probably just a little trap, and they hold short. So that is another way to get out. So if you see a clear sell signal, you get out. But if you see a pullback that just keeps pulling back, and then it suddenly accelerates down in a breakout, the market's in a bear trend. Whether or not you thought it was a bear trend, the market is in a bear trend. So you get out. And if you're an experienced trader, not only do you get out, but you short. You go short. And whatever, let's say you bought at the high of the bull trend, and now you got this pullback, and then it suddenly breaks out and you exit. So let's say you lost 10 points, or $10 in a stock, right? Usually, I would say 70 or 80% of the time, the market will continue down for at least the size of your loss. So you'll get a measured move down based upon the height of that bull flag. So, so it makes sense to go short. If you go short, you'll make back pretty much everything that you lost, but it's hard to do. It's not something beginners can do. Right? That's the kind of thing that you really have to be an experienced trader to do, and it takes a long time to get there. Beginners should always have protective stops.
If you are enjoying this interview so far, then I think you'll like this one over here. I've been working on this book for a long time called Prop Trading Secrets. It's finally out. You can get it in your favorite bookstore or on Amazon, Barnes & Noble, of course. And this book is really about interviewing traders who are successful in either trading for prop firms or managing their own private fund. We talk about their background, what makes them successful, the things they went through, struggles they had to go through to become good traders now, and a lot of the good wisdom that you might not necessarily hear about, but it's all into a condensed version over here. You can read through these stories, get inspired, of course, learn a lot about what they do, their strategy as well. And we summarize everything at the end, where we have a whole chapter of summaries of what these traders have in common. So if you want to check it out, 14 traders in this book that myself and Kathy Lean interviewed. There's a lot of good wisdom in this. If you like these interviews on YouTube, I'm sure you like this one for sure. Go grab it. Like I said, it's on Amazon, Barnes & Noble, it's on Audible and audio version. All the other audiobook platforms will have it too, or your favorite bookstore. So check it out. If you did read it, let me know in the comment section below which one is your favorite chapter, and we'll get back to the interview. I think what's tricky too is what's in the chart versus what the trader believes are two different things, especially beginners. They might see the patterns, but they believe something else. They believe the trend will continue, and they believe they should stay in the trade. And then it's tricky because then they get out too late, or they see price reverse way too far before they get out. How do you kind of avoid keeping that bias with you when you trade?
I don't have a bias. I say, oh, look what it's doing now. I don't say, oh my gosh, I can't do that. I'm not emotionally attached to anything, and I freely admit when I'm wrong. I don't. This is how I am now. This is not how I was 40 years ago. 40 years ago, I would just get torn up inside. I can't re-experience those feelings, but I have the memory of it. But it was just horrible, horrible, horrible. I remember, how can the market do that? That's so unfair. Goldman Sachs is stealing my money. BlackRock is stealing my money. It's just all nonsense. It's just, I screwed up. I didn't have enough experience. I didn't have adequate protections. I didn't have protective stops. You can make more money not using stops and scaling in if you have the ability to recognize when you're wrong. And that's a real problem for beginners. Even if a beginner recognizes that he's wrong, most beginners don't give up. They say, oh my gosh, I'm down $1,500 on the day. I can't, if I exit, I'll have lost $1,500. I'd rather hope that the market turns around and maybe I can get out with an $800 loss or $300 loss. And that's hope. And hope is not a trading strategy. hope is, that's one of, those trades that come every few weeks that wipe out everything good that you've done for the past 3 weeks. So a beginner should always have a protective stop, a logical location for a protective stop. An experienced trader might use a protective stop in some circumstances, but otherwise he's just going to rely on the market to tell him when he's wrong. If he sees a clear sell signal, he's got to get out. If he sees a pullback that looks like it's growing into a bear trend, especially if it's starting to break to the downside, he has to get out.
That's a good point. What I'm hearing a lot is people say that price action is for them too subjective. It's like depending on each person, they see it differently. You're one of the few people who've been able to make price action very, 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 very systematic and very clear. How do you make that price action clear and like the same for everyone else out there?
For 40 years, I've, at the end of the day, printed out, back in the days when people would print, I'd print out the charts every day. I would look at every pattern that I could find on the chart. And over time, I started to develop a sense of probabilities. How likely is this pattern going to succeed? How likely is it, not going to succeed? And for the past 10 or 15 years, maybe longer, I switched to just creating PowerPoint slides of the day. So I'll put a chart in a PowerPoint and I'll mark it up. I'll draw lines, trend lines, support, resistance. I'll highlight patterns like wedges and double tops, double bottoms. And then I'll categorize everything that I see. And then, so I'll make multiple copies of that chart. An average day, I might make 5 charts, 5 copies of the chart, sometimes 10 copies of the chart. So if one part of the day had a bull trend from the open, I'll put it in my collection, my PowerPoint folder of bull trends from the open. If there's a double top bear flag, and I'll put another copy of the chart highlighting the double top bear flag in my collection of double top bear flags. And so I have hundreds of examples of hundreds of patterns. So I'm sure I have well over 10,000 charts categorized, and and I regularly look at the charts, and I develop a sense of probability. So when I see a pattern, how likely is it going to go up? How likely is it going to go down? How far is it likely to go up? How far is it likely to go down? If the pattern starts to go do the opposite, if it's a double bottom and the market starts to break out below the double bottom, what do I do? How likely is the breakout going to lead to a bear trend? How likely is the breakout going to reverse back up and become a trap? So over time, I've just developed what I think is a good, reliable sense of probabilities. But you don't even need that. We live in a 40-60 world as traders, okay? If ever you are more than 60% confident in something, you're probably wrong. And whenever you are less than 40% confident of something, you're probably wrong, okay? 95% of the bars on every chart have a probability of going up X number of ticks versus down X number of ticks. The probability is between 40 and 60%. Okay. So if you're long Apple, the chance of the market going up $1 before going down $1 is going to be between 40 and 60%. Okay. Only 5% of the bars on a chart are high probability, 70%. So when the market's in a strong breakout, for example, up or down, there's a 70% chance it's going to have a second leg up, and a 70% chance it will have some kind of a measured move up. So, but going back to the 40-60% thing, since the probability is never less than 40%, and never more than 60%, at least 95% of the time it's not. As long as you try to make a reward that is at least twice your risk, even if you're wrong 40% of the time, you're going to make money. So a beginner should always look at a chart and think in terms of trying to make a reward that's at least twice as risk. In other words, you should be looking at swing trades. as a trader gains experience, he can start to scalp. Learning how to scalp is really important because a swing trade has a 40% chance of working. That means it has a 60% chance of not working. And if it's not going to work, you have to get out. And you can either get out with a small profit or a small loss. And therefore, when you're dealing with small profits and small losses, you're scalping. So even a swing trader is going to be scalping most of the time. An experienced trader, in addition to swing trading, will take a lot of scalps. There are, if the E-mini has 81 bars in a day, if you count the aftermarket, you can say 78 bars in the actual session. I see a trade on every bar during the day, every bar. So, that doesn't mean I take trades on every bar, but there's something to do on every bar, either buy or sell, or buy and buy more lower, or sell and sell more higher. So with experience, you start to see all these trades. I mean, it's just crazy. It's just crazy how many things are going on. And as you get more experience, you can make a lot of money scalping. It's hard to look at a 5-minute chart and watch 81 bars go by during the day and take trades every 2 or 3 bars. It's just emotionally hard. You get emotionally drained. Anytime you're doing something really intensely intellectual, writing a book, coming up with questions for a podcast, it's hard to stay intensely focused for much more than an hour or two at a time. And that's how I trade. So sometimes I'll trade very intensely, and I might take 3 or 4 trades in an hour, and then at other times I'll see stuff that I could trade, but I'll say, I just don't. I'm resistant. I feel lazy or tired, or I feel resistant to being intensely focused. So during those parts of the day, I trade less, and sometimes I'll even go an hour or two not taking any trades, even though there are trades to take. I only want to take a trade when I feel I'm at my best. Because your margin, the difference between consistently making money and consistently losing money is very small. It's very small. So, if I'm not feeling at my best, if I'm not feeling like I can concentrate really, really well and manage the trade properly, I won't take the trade. But if I'm feeling good, I will take the trade. Some days I'll have a doctor's appointment, and I'll disappear for an hour or two. I'll come back, and if there are a couple hours left in the day, I know there'll be several more trades to take, even if the market is extremely quiet, pretty much all day long. And there's always some kind of a trade. In the last couple hours, there's always going to be at least one trade, a buy or a sell, that comes with a good signal bar. So it's a high probability trade. So even if I've been at the doctor's office for 2 hours and I get back and there are 2 hours left in the day, I'm very confident that I'm going to see at least one trade where it's going to be a high probability, very good scalp. So, no matter how boring the day has been, in the final third of the day, there's always going to be, something. There's always going to be something good.
I want to get your thoughts on how you adapt to different markets. Let's say like the afternoon versus the morning, or it can be like a tariff market versus the quiet summer market. Is there a difference in how you trade, or is it the same pattern you look at?
I do the same thing every day, and there are certain behaviors that take place on the open that are different from the rest of the day. There are certain things that happen at the end of the day. And if the open and end are different, that means the middle of the day is different from the open and the end. For example, on the open, let's say you get a strong move up or down that lasts 2, 3, 4, 5 bars. Okay, 50% of the time, it's the wrong way. 50% of the time, it's a test of support or resistance, and the market's going to reverse. So, but later in the day, if the market's in a trading range and it breaks out 4 or 5 bars, 70% chance it's going to go up for some kind of a measured move. If it breaks to the downside, 4 or 5 bars, 70% chance it's going to fall for some kind of a measured move and have at least 2 legs. But on the open, you often will see one very big bull bar, and then the market will reverse, or 1 or 2 very big bear bars, or 4 or 5 big bull bars, or 4 or 5 big bear bars. And then the market suddenly reverses and trends for the rest of the day in the opposite direction. That is opening behavior, and it's much less likely to happen later in the day. Also, a lot of times you'll have one type of behavior for the first 4 hours, 5 hours, and then a different behavior into the close. So, suddenly, let's say the market's been in a trading range, and then suddenly the market will trend up or down at the end of the day. Or sometimes the market will be trending all day, and then in the final 90 minutes or so, it'll pull back, and it'll pull back very, very far. I'm just open to everything, but I do approach things differently. At the end of the day, there's a higher chance of some kind of a trend, a surprise trend, just suddenly happening. At the beginning of the day, there's a higher probability that any strong move up or down is in the wrong direction. That it's just a vacuum. You get vacuumed down to support, vacuumed up to resistance, and then the market reverses. But the patterns are basically the same all day.
Since back with good advice here, I want to give you some time to tell people where they can find you and when they can learn from you, and details about your course too.
Well, you can go to brookstradingcourse.com, and there's a lot of information there. I'm in a chat room for 4 times a month, and I talk about trading in the chat room. And then on the videos, I talk a lot about trading. The videos are on how to trade. I also have some books that I wrote a number of years ago. I'm currently working on a very big collection of books, basically an encyclopedia of chart patterns. I said I have 10,000 charts. Well, guess what? I'm probably putting about 1,500 of the charts into a book. So I'll give 10 or 20 examples of wedge tops, 10 or 20 examples of wedge bottoms. People, when they hear wedge, they think of in their mind, a rising wedge. They think of something that's actually wedge shaped. But most wedges are not wedge shaped. Most wedges are just channels. And I have lots of examples of things that I call wedges, and most people would not call wedges, but they have the same forces at work as wedges, and and they behave like wedges. So I have many examples of all those oddball things that most traders would overlook, but in fact the market is giving very useful information. But brookstradingcourse.com is a good starting point.
Awesome. Definitely want to see that book in the future coming out. That would be awesome. And we'll leave the link below for your course. People can check it out in the description below. Podcast show notes. Al, it's been a pleasure to be here once again, and good to talk trading again with you. And I hope to get you in the podcast pretty soon.